The following presentation is brought to you as a courtesy from Forex Academy. This is part of our service, Live Beginner's Course. If you find it interesting and wish to be updated on new releases, please subscribe to our YouTube channel or join our community at forex.academy and receive all our services for free. Your like is also highly appreciated. Enjoy.
Hello and welcome to the Live Beginners Trading course here presented to you by Forex.Academy. My name is Robert Blackwell. I have the pleasure to walk you through today's education here on the Beginners Trading course. We will be discussing today becoming an active trader and really getting involved in placing and looking at some different types of trading orders, how to enter the markets, how to manage trade positions, and then we'll finish off with some things really discussing what not to do as a trader. So a very interesting lesson indeed. Now, before we do so, please, there is risk inherent when deciding to trade the financial markets. So please do discuss and consult the following disclaimer. Okay, so now that we've taken the risks on board and obviously looking to trade the financial markets, I'll just walk through a few pieces of housekeeping before we begin. Feel free to ask questions throughout. There is, of course, a live interactive function where you can use the chat box to ask questions there. So on the right-hand side of the screen, simply type in your questions there to your chat box. I'll be able to see them here in office and be able to correspond with you guys. This live webinar is being recorded and will be placed into your members login area. So you'll have it fully for revision purposes just thereafter. And of course, we'll have a Q&A session at the end of this live webinar. So just to go through some of your final thoughts on today's topics. So let us begin then the course overview. Of course, we've finished off so far this week with the trading toolkit. Protecting capital and risk management was, of course, yesterday's lesson where we discussed probability trading. We aim to stack the odds in our favor as financial traders, particularly for technical analysts. That's how we trade. And we looked at different conviction statuses to trades, or risk reward in trading exposure, and then effectively looking to manage risk on each particular trade is, of course, our objective. Now, today we'll be going into more of an active discussion on becoming an active trader, guys. So we're finishing off with the beginner's trading course. I would imagine we've learned quite a lot with this 2-week journey so far. Today we'll be discussing trading different order lots, of course, starting with 0.01 lots. We'll be looking at order types and looking at trading with technical analysis there as well, whilst undergoing the capital appreciation of course, risk management and trade management as well. Okay, and that'll lead us on nicely then to the trading workshop tomorrow, where we'll be delving into putting all of this into practice. What we've learned over the last 2 weeks, over the last 8 lessons, will be going into, of course, our practical trading workshop tomorrow. Okay. So let us move on then to today's particular lesson. What will we be discussing in today's lesson? Well, the outline will discuss beginning trader tips, trading requirements, market execution, pending orders, stop losses, limit orders, entering the market, trade management, and we'll finish off then with trade management, some topics on how not to trade, and obviously that brings us into risk appreciation. Okay, so it's a fully fledged lesson to get you thinking more practically before we decide maybe to look at entering the markets. Of course, we're ready to become an active trader perhaps, and we'll finish off obviously with the practical workshop tomorrow that will actually put this on into practice on the MT4 trading platform, trading a range of forex markets and equity indexes and commodities as well. So first and foremost, let us start with some beginner trading tips. Okay, beginner trading tips. So just as we decide to become an active trader, we'll want to have a feel for the markets and start off with some beginner notions of developing ourselves as traders. There is a substantial benefit to beginning your trading career by choosing to accept small amounts of risk. As you step into the live markets, your focus should be on developing consistent trading strategy. Trading with minimal risk will afford you the objectivity to do so. Try trading all forex pairs with 0.01 lots when beginning. Now, can we see, guys, why this might be an advantage to us? Why might this be a serious advantage to us? Because, well, we're not focused on the risks involved. We're not focused on the monetary exposure at this stage. We're focusing on developing a trading strategy, one that works. But we need to be trading live, so we take it seriously. And obviously, we need to have some skin in the game to be an active trader and to feel the level of discipline in our trading. So there is a huge advantage to trading with small trade size, something like the Forex pairs that are quite volatile, that experience good price movement and opportunity, but with trading with minimal risk to start off with. Avoid having too many open trades at one particular time. Of course, so don't overthink, don't overtrade. Try and use your strategy, try and use some of the lessons that you've learned, some of the ideological and educational viewpoints that you can look to enter and manage these trade positions. So avoid having too many open trades at the one particular time. Don't be afraid to take your first winning trade. Okay, it will, of course, trading is a level of confidence. It's a level where we're all focused on, developing ourselves, and obviously the better that we think we're at trading, the more active we'll be in applying our trading strategy. But don't be afraid to take your first winning trade. It's going to show you guys that you can actually make money in these markets, and it's not a mug's game, that you can develop yourself and trade consistently. And of course, when you have a small account and you perhaps make a small trade and take your first €10 winner, well, that just shows you guys that you can actively get involved in these markets. Yes, you're going to take losers, but you might be able to take 4 or 5 of those €10 winners a day, and 1 or 2 losers, of course. And that shows you, well, look, you've made some money one day in the markets. You effectively beat the markets that day. Of course, you can focus on trying to develop this on a consistent basis. And again, don't be afraid to take your first losing trade. So very, very key point there in terms of risk management. When the market moves with you, if it's your first trade, don't be afraid to take a good winner if it's there. But again, if your stop loss is intact and your first trade is going to be a loser, don't be afraid, guys. It's just part of the game. So let's talk about trading requirements, because this is often misconstrued from the retail trading perspective. You also get a lot of retail traders who look at us or professional traders and say, well, how many screens do I need? Do I need 10 different screens? What do I need to be looking at? Let's go through some of the real trader requirements here, and we'll hopefully answer some of these questions, because it's quite basic. What is needed to begin trading? Well, a strong internet connection is obvious. You need a strong internet connection to follow the markets. Only one PC monitor. Only one PC monitor is needed if you're trading on the MT4 trading platform. That is all that's needed. You can breeze through the different markets, of course, depending on the time frame, of course. More specifically, if you're trading 30-minute price charts or daily candlesticks, of course, you do not need more than one PC monitor, okay? And of course, have the facility to trade with leverage that you're able to do so, okay? A recommended starting account balance of €1,000 is, of course, recommended. Now that's indicative of what you'd like to trade, okay? So if you're looking to trade only the Forex markets, you could trade with a smaller amount, of course. If you're looking to trade, and the reason why we say at least €1,000 to start off with, guys, if you're looking to trade all opportunity, what I mean by that is, allow yourself, doesn't mean you have to get involved in every single market that's moving, of course not. But if you want to trade equity indices, if you want to trade equity single stock CFDs, if you want to trade the Forex CFDs, if you want to trade commodities as well, perhaps you'd like to trade cryptocurrencies as well, you will need a certain amount of on account as your margin account, of course, and you need that account to be able to accept these trades. So if you look to trade all asset classes, which I would suggest you should, of course, you'll be looking to start off with the minimum I would recommend of €1,000. Okay, so nothing too stringent in terms of starting off your trading career. One PC monitor, an internet connection. The MT4 platform, of course, is free with JFX, and you can have your own trading account funded by yourself. Let's talk about market execution. Okay, so this is going to be our first order that we're looking to enter the markets with. In choosing to trade via market execution, we are simply deciding to buy or sell at market or at the current market price. Traders will choose a market execution order when they want to enter the market now So right at this moment, the market is moving. I want to get on this trade. I want to buy that market now. I choose a market execution. This ensures traders enter the market at the next best price available. Traders are therefore able to react instantly to current market conditions. Okay, so does that make sense, guys? To current market conditions. Market entry is therefore totally subjective, and that is focused in on of course, entering the market as is just there at the moment. Okay, so if you're trading more specifically short time frames and if you're scalping the markets, of course, you're going to look to choose a trade via market execution. Okay, pending orders. Okay, so maybe we're familiar with pending orders. They're quite the opposite. So pending orders allow traders to place orders in the markets at specific prices. When the market price reaches the pending order target price, the trade is then executed and becomes an active open trade position. Okay, so you're placing an order in the market, waiting for the market to come to that order. That is the price you want to enter at. Pending orders can be placed both above and below the market at the current market price. Okay, pending entry orders are called buy stops and sell stops. So those orders, those pending orders placed above are going to be buy stops. Those pending orders placed below the current market price to follow that momentum are called sell stops. Okay, they are different than stop loss orders. Okay, completely different. Your stop loss order is of course your stop loss, your line of defense, your defense when the market is moving against you and you don't want to take a further loss. You'll use a stop loss, okay, which we'll discuss. So how do we use these pending orders? Well, we'll look at a buy stop first of all. Okay, now the order is placed above the market, and again, order is only triggered if the market reaches that price. So let's say we have the market trading like this from left to right. Current market price is set to 2,700 there, and we see this little technical setup. Perhaps we want to buy. We think if the market's strong and it breaks this, this price action over the past, let's say the past few months, well, we want to get involved in that trade to the upside. Okay, so we'll effectively place our buy stop order at that price. Now, just for an example, what happens here is the market trades up. Okay, it effectively trades up, and we get our long order executed from the price we chose. So 2,740 is the price we're long at. The market trades and it continues to go. So that was a very structured technical break that we perhaps wanted to trade. And instead of trying to buy at a lower price because we're not sure where the market's going, as a technical trader, we only want to buy the breakout of such a price. So inevitably, we get involved at that price. The market trades up. The objective is obviously only to realize the move if it occurs. Okay, if the market trades sideways, which we'll discuss, we won't effectively realize that objective. So again, you can use a different pending order called a sell stop. Okay, this is an order placed below the market, and it's only triggered if the market reaches the price or realizes the price in question. So let's say the market is trading around this again. We'll use a different order this time called a sell stop, and we'll look at this level and say, well, if it reaches this sort of medium-term low, we think the market's weak and it's going to break through that. So we'll place our sell stop order at that price. Okay. Evidently, what could happen is the market does trade down. We get that order realized, and we get a short then from our level 2635. Again, you could say, well, if you're looking to sell the market, why don't you just sell at that market? At market execution, you get a better price for it. Again, there's an objective here, a technical objective perhaps, where we only want to make the trade if the opportunity is realized. So that's the advantage to using pending orders. Again, these are the two orders that we placed in the market. So again, I'd just like to reiterate this. What are the benefits to using buy and sell stop orders? Absolutely, yeah. Okay. We only enter if the trade opportunity has been realized. If this market, let's say we have a total directional bias in this market, only to buy this market, okay? We place a buy stop, and the market trades, and it trades to the downside, okay? Well, effectively, we don't take a loser in that trade because we didn't place the trade. The market didn't execute our order, and we forego the trading opportunity. Let me use another example. Let's say we're not sure this market is where it's going to trade. It's trading a range for a long period of time. Okay, well, we can use two different orders. We could potentially use a buy stop order. Okay, we could use a buy stop order or a sell stop order to effectively trade this range. So if the market trades up, we'll get that order realized. If the market trades down, we'll get that order realized again, and we can follow the move hopefully to the downside or upside. So again, we only enter the trade opportunity if it has been realized, if we get that executed. Okay, so really good advantage to using technical pending orders. Remember, stop losses, of course, are so important to use in these markets, guys. You always enter a stop loss in a trade. As soon as you execute the trade, you should be looking to input that stop loss or at the same time. So remember, stop losses are your protective line of defense. They are your protective line of defense. The price to exit at a loss if the market fails to meet your expectations. So just think about that, guys. Why might that be a good idea? Okay, the market is failing to meet your expectations. So I'll just give you a moment to write some answers there in the chat box. Why might that be a good idea to use a stop loss, of course, if it's not meeting your expectation? Okay, and I can see many comments coming in. Yes, effectively, because guys, we are wrong. We are incorrect in the decision. And once you've made a technical decision that, let's say, this market is moving to the upside, you've used perhaps your order to execute the market there, and you're long the market, but the market pulls back and triggers your stop loss. You are, of course, wrong, and the market is trading to the downside. So it's failed to meet the expectation. That's fine. We're effectively wrong in that trade, and we're simply taking a small loser, as is. Losing trades are inevitable. Profitable traders can cap losses. Again, capping losses is what you want to be able to do. So I'll give you an example here. This is more of a structured approach on a very large trading account, okay? So let's say you have a 1,000 euro trading account. Okay, and you're using small trade size, of course, and you're looking for weekly trades, perhaps. You could potentially trade, 10 losing trades. Let's say if your stop loss is around €5, okay, but you're looking for a decent move in the market, and you're just getting stopped out of these poor trades. Then your 11th trade comes along, and you are still using your €5 stop loss. But if you catch that trade that you're looking for in a particular market, you could, of course, get that 60, €70 winner, no problem. So effectively, guys, that is what we're looking to do. Now that's an extreme example in terms of a risk reward ratio, of course. However, guys, we're looking to always cap the losses of our losing trades. That is the point to stop losses. It's our line of defense. We have a predetermined capital amount in our heads that we'd feel comfortable with losing on the trade. Now, we don't want to lose that on the trade, but that is what we feel comfortable with. So that is, of course, our stop loss effect. And very importantly, which we'll discuss throughout this lesson, stop losses can be moved, guys. They can be moved to look to capture in profit. So if we actually, make a trade, the market moves up with this. Let's just analyze this trade in depth. Let's say we enter oil here at 61.50, okay? Actually, we'll change this just given the new movement in oil to 69.50 per barrel, okay? And the market trades up. Perhaps we have a pending order, just this price here. Market trades up and catches that order and continues to go, okay? If it continues to go, perhaps when we are at this price here, we'll call it A, right here, and our stop loss is still here. Well, guys, effectively we're running a very poor risk reward on the trade, even though we're at the high of this market in question. And that is because, guys, we haven't monetized any of this risk off the trade. What we'll be looking to do is actually move our stop loss perhaps to here, which is just above our break-even price. That mitigates risk off the table. And guys, if you can start to get as many mitigating trades off the table as possible, all of a sudden you'll find yourself with a portfolio of open trades that are totally risk-free because you've effectively mitigated the risk off the trade. They're in profit and they're moving. Okay, and that is the idea of portfolio diversification. So then alternatively, what you could look to do, okay, so we'll change color here and we'll call that SL1. The market, as you see, it's moved up. So, what we could look to do is use this last corrective low here and effectively look to book in some profit. And again, we'll call that SL2. Okay, so the market is at point A right now. Effectively, we've mitigated risk of the trade, perhaps to the extent where the oil market now is now at $71. We've made already $1.50 on the trade. Okay, so that's great. So we've mitigated risk. There's no risk on this trade. This is the only risk, and that is profit pullback risk. Okay, we can continue, of course, to move the stop loss up to here, these points, if that occurs in time. So that is effectively how we manage trades, and we'll be discussing this in a lot of detail. So here we have the S&P 500. Again, we're buying the market. What do we look to do? Well, we enter the market at this price. It's a long market entry. Evidently, what happens is the market continues to trade to the upside. But first thing we do is place our stop loss. Okay. Now, why might we choose this? Well, simply because, well, look at the candle that we're buying. We're buying the high of this candle, and it's quite a strong candle. If this full candle reverses the next day, well, the reason why we got into that trade no longer exists. Okay, so we place the stop loss below that candle, and then we see the market move up, albeit with some volatility over the next 4 days. Until then, it shifts to the upside, and I'll just point this out in time. Right at these moments here, we see a continuation trade. Okay, so great. We're effectively following this momentum. Okay, so evidently what happens is the stop loss, we can look to mitigate this risk. We can, of course, say, well, the market is continuing to trade up. Where do we look to mitigate this risk to? Well, again, perhaps we use the last corrective low of said candles. So at this point in time, when the market trades up to here, we could, of course, use this candle. Or perhaps we haven't mitigated that risk just as of yet. And when we see the last corrective low, perhaps we're at this point in time here, we know that the market has pulled back, so we don't want that to retrace at these levels here, nominal levels right here. So we use the low of that candlestick to place our stop loss here, and it's the last corrective low of the last bearish candle within a very strong trade. So effectively, that's what we do, guys. We've mitigated the risk of the trade. Stop loss has been moved higher, and again, as the market continues to trade up, it's question time. It's question time for us as traders. What should we look to do? Let's go through some hypotheticals here. Well, very strong candlestick right there. I would say let's move our stop loss up to the low of this candle here. Okay, so this is now our stop loss 3, which is a great trade. We've effectively booked in quite a bit of profit here from our entry. Evidently as well, we see some volatility in this little range. What we can look to do is choose this candlestick here, very strong candlestick to the upside, and use our stop loss right in here. So I'll just pull this over to here, and that is effectively stop loss 4. So as this market is trading to the upside, we are moving our stop loss in tandem to protect profit on the trade. Let's continue to move to the upside. You don't know what could happen, of course. You're simply letting the markets dictate how they trade whilst protecting yourself. And evidently, of course, we know that the market reversed, and you would have lost all of that profit if you did not have profit protection in place. So let's go through then potential trades here that we can discuss. Okay, and this is a different example. We have the euro US dollar. We're looking to sell this market, guys. Why could we look to sell this market when the market's trading to the upside? Well, of course, we don't know that that's the case. What we see here is perhaps a level of support and resistance. Again, respectively discussing these areas here within the market. These are the highs previously from August, September time here. Okay, so these are our highs from 6 months ago. We're now trading roughly around this time, January. And of course, we see these highs being rejected again. So we take a short trade, potentially looking for new lows around this level here. So whatever analysis suggests, we could potentially get some profit around here. Evidently, the market moves to the downside, guys. Can you see that it moves to the downside, but creates lows at these prices here? So Question is, what do we do? Should we not move our stop loss? What do we do? Of course, well, evidently when we entered this trade, we know we placed a stop loss. Of course we did. We placed a stop loss above the corrective highs. The market trades down to the downside. Unfortunately, it doesn't give us too much price momentum. So we could have effectively moved the stop loss down a little, but let's say we're giving it some room. Now the advantages, of course, let's just talk specifically about the advantages of using the stop loss is, of course, the market pulls back and evidently it trades to the downside, reverses, and gets us out for our small loser. So that is absolutely fine, guys. It's absolutely fine because our stop loss is triggered at that point. We have taken a small loser on a trade that just did not work out. It's absolutely fine, guys, and we know that, we effectively look to trade this support and resistance level. Perhaps the trade didn't work out this time. We've taken a small loser. We brush ourselves off and we move on. Okay.